What's up, guys? Welcome back to the channel. Last week, we talked about the candle range theory, where I explained exactly how to trade the candle range theory with entry patterns. During the last part of the lesson, I made mention of context, where you trade candle range theory with order confluence, which is going to make it a high probability trading setup. This is exactly the comment I made. I said, to apply the candle range theory effectively, you need to understand time frame alignments. I equally said this involves having a strong framework for top-down analysis. So this means if you can trade the candle range theory, understanding price across different time frames and understanding the fractal nature of the market, this means you will be able to identify a high probability candle range theory pattern and the best ones to trade as well. Now, you need to understand that when we talk about time frame alignments and understanding top-down analysis, we usually do top-down analysis with three different time frames. Personally, the way I teach top-down analysis, I've made a couple of lessons on top-down analysis on this channel. I said that we usually do top-down analysis with three different time frames. The time frames is a higher time frame, medium time frame, and equally the lower time frame. Now, the higher time frame is usually the daily time frame, and what we do there is trying to find daily bias. Secondly, the medium time frame, where we're going to mark other blocks and possibly our supply and demand zones, and lastly the lower time frame, which you're going to use as our entry time frame. So these are the list of time frames you need if you want to do top analysis. That's the way I teach it. A different mentor might actually come up with something different. Now, I equally went ahead and said that trading from key levels such as supply and demand areas, your order block, your fair value gaps, and trading from key liquidity areas, that's areas where price sweeps liquidity. This is actually going to help your candle range theory pattern to play out more effectively, and it's actually going to increase the probability of them playing out. So this is what we're going to cover for today. I'm going to teach you how you can spot high probability candle range theories by just combining the concepts I'm going to teach you in today's lesson. That is understanding price across different time frames, understanding the fractal nature of the markets, understanding price from time frame to time frames, combining it with your key areas. Your key areas could be your PDRA, supply and demand zones, fair value gap, and liquidity sweep areas. Let's jump straight into that. But before that, if you're totally new to the channel, I'm Solomon Wisdom, and here is Born to Trade. If you're interested in learning smart money concepts, subscribe to the channel and be part of this community. If you have interest in joining our free Telegram community, link is in the description. You could look to join us now. This is the candle range theory pattern. And when I talked about this pattern last week, I said that it's usually a three candle pattern, but I actually went ahead to explain that the major goal is that when price sweeps the liquidity above this particular candle, because if you watch the particular candle, I identify this candle as a range. I said for you to trade the candle range theory effectively, you need to understand that a candle is a range. So liquidity rests above the candle high and the candle's low. Now, what you see right here is that price moves, sweeps the liquidity with a wick. You see how price sweeps this liquidity with a wick and close back inside this range. Now, when this happens, you have an expectation. What is your expectation? Your expectation is that price is going to target the sell side liquidity. And when I was explaining, I said that price could possibly target the sell side liquidity with a single candle. Now, I equally went ahead to explain that it could be with series of candles, just like we're seeing right here. We see price targeting it with series of candles, more like 2, 3, or even 4 candles, right? So this is it about this particular concept. If you're struggling to understand this part, I think you should go back to the lesson. That is the first lesson. That's where I explained it, and I can equally link it in the description so you could just access it easily. Now, I equally went ahead and said for a candle range theory to be valid and have high probability, price has to sweep the liquidity and close back inside this range. If price forms a pattern like this where it's closed above this particular high, this is not actually a sweep, this is a break of structure. So this particular one has low probability. That's what I explained in that particular lesson. Now, moving ahead, I equally said that key levels such as your supply and demand, your order block, fair value gap, and areas where price sweeps liquidity, this is actually going to help improve the probability of this particular pattern playing out. Now, what you can see in this case is that this is a key level. Price tags into a key level. So when price starts into a key level, maybe probably your supply zone in this case, what are you going to do? You see, on the higher time frame, you already have the bias. So let me shift this. Now, on the higher time frame, you already have the bias that price is going to continue lower, right? because I said that you need to understand price across different time frame. Now, this is your higher time frame, and this is possibly your daily time frame. What are you seeing on the daily time frame? On the daily time frame, you see that price sweeps the liquidity above this particular high. That's what you're seeing on the daily time frame, and price is going to target the sell side liquidity. Now you have a bias. Price is bearish. Now you already understand that. That's what you're seeing on the higher time frame. Now on your medium time frame, what you're going to do is possibly identify your key level, right? Your key level could be your supply and demand areas, your order blocks, or even your fair value gap. So if price starts into a key level, you see this is going to improve the probability of your setup playing out. And lastly, you're going to drop to a lower time frame to do what? To get your entry. And once you get your entry, this is where the work is done. That's when you're going to target those sell side liquidity. And one thing I want you to understand is that our target is usually this sell side liquidity. But once price mitigates this key level and having the CRT pattern right here, this means that price could move beyond this sell side liquidity. Price could drop deeper. Why? It has other confluence which has made it a high probability setup. One is that it's reacting from key level and it equally swept liquidity. So that's the same for the bearish example. You already understand this pattern right here where price sweeps liquidity. In this particular point, let's assume that the key area, that is the point of interest right here, is maybe an old low. In this case, liquidity resting underneath an old low. Now what are we seeing? Price comes right here, sweeps the liquidity underneath the old low and closing inside this particular range, as well as sweeping the liquidity underneath this range, right? Now, what's the expectation? The expectation is that price is going to target this key high. But since price swept the liquidity underneath this low, closing back inside this range, the probability has now increased. Now, we're going to anticipate that price is going to sweep this particular high, not just sweeping this high. We're going to anticipate a continuation to the upside, right? I hope this makes sense to you. Let's see live examples. Let's not waste time. Let's see live examples, and I hope this is going to help you understand it better. So this is going to be the first example right now, and I hope this is going to help you understand how to trade the candle range theory with key level, right? Combining it with PDR rates. This is going to improve the probability of your setup playing out. This is actually Euro card, and this is on the daily time frame. And this is a recent price action. This is on the 15th of November 2024. So this is a current price action in case you want to do your own personal backtest. Now, what you can clearly see right now is that price is bearish. And one thing you will understand is that price moves in waves, right? Once we have a drop to the downside, we're actually going to expect the retracement, and after the retracement, or we call it the pullback, we're going to anticipate a continuation to the downside. Now, firstly, we have an expectation that price is going to continue to the downside. Now, that's not why we are here. We're going to anticipate a candle range pattern. Once we identify this particular pattern, this is going to help us. So let's play price forward and see. So this is the next candle right here, and you see we have a clear candle range pattern. So price sweeps the liquidity above this particular high and moves back into the range. Okay, so this is the first thing we need to see. A CRT pattern, price taking liquidity and closing back inside this range. And I said this particular pattern has high probability because it closed inside this range. Now, this is what you've seen on the daily time frame. The daily time frame has given you your bias. What is your bias? Your bias means that price is now bearish. We're going to anticipate that price is going to drop to the downside and is going to take the liquidity underneath this low. Your bias right now is that price is going to target the sell side liquidity. So that's not all. Initially, you can decide to drop to a lower time frame to look for your entry. But in this case, you're actually going to look for some other confluence that is going to improve the probability of this playing out. So what else are you going to look for right here? This is where we're going to need the medium time frame. And you can clearly see from here that we have a key level right here. I hope you can agree with me that this is a key supply level. And price taps into this supply level. I hope you can see that price taps into this supply level. So this has now improved the probability of this playing out. So some people is going to argue that this is not actually a supply level. So this is why top-down analysis is very important, understanding the fractal nature of the market. So let's drop to the medium time frame, which is our 4 hours time frame. So this is the 4 hours time frame, and you can clearly see that we have a zone right now. And if you know how we usually identify our zones, if you know how we identify our supply and demand zone, you can see this is a very good one because you see we have a little range right now. Price rapidly drops to the downside. So this is a high probability supply zone in this case because price left some inefficiency and we have the mitigation of this particular level. Now, what is the expectation? The expectation is that price is going to take this particular low. Now, have it in mind that price can move beyond taking this particular low. We can actually see price moving very far away from this particular low, right? Since we've identified this key level on the 4 hours time frame, this is where getting an entry is actually very important, and our entry time frame has to be the 1 hour time frame. So let's see the 1 hour time frame. So this is the 1 hour time frame right now, and this is where you're going to look for your entry. So if I try to zoom in right now, what can you clearly see? Price mitigates our key level by sweeping the liquidity above this previous candle, right? So this is where you're going to get your entry, and you see we have the break of this particular low right here. Price breaks internal structure. So personally, if I want to get involved in this particular trade, I'm going to trade from an order block in this case, right? I'm going to trade from an order block. And if I try to identify the order block I'm going to trade from, it has to be this extreme order block. But for this particular example, price couldn't get to the order block. Price reacted from a fair value gap. So if you usually trade from a fair value gap, congrats to you. And here is going to be your entry. You're going to set your sell limit right here. And once price tags in your sell limit, you've activated your trade, and you're going to look to trade to the downside, targeting this sell side liquidity and possibly the external range liquidity. Okay, so let's press price forward right now, but I'm going to do it a little bit faster because we have other things to cover in this lesson. So playing price forward, what you see, price comes, taps inside the range and activating your sell order. Now price moves away from there, and what you see right here is that immediately price sweeps this liquidity, it moved back inside the range. Now continue to play price forward. Price is still dropping. So let's see what it looks like on daily time frame. So on the daily time frame, you see price taps into the fair value gap and it drops, sweeps the liquidity. But price actually continued to the downside because it's reacting from a key level, a key supply level, combining it with CRT. So playing price forward, let's see. This is the current price action, today being the 21st of November, right? This is the recent price action. So this is why I said this has high probability of playing out. So imagine you getting your entry right here and holding up to this point. You can actually make about 20 to 25% from one trading opportunity. So let's see more examples. Now let's take a look at Bitcoin and see what's happening on Bitcoin. So from here, you can see this is actually on 11th of October. Now, what you can see right here is that we have a CRT pattern right here. I hope you can see that. We have a CRT pattern and price sweeps the liquidity underneath this low and close back inside the range. Now, what other confluence do we have? Price sweeps liquidity underneath this low. You see, we have an old low right here. Price equally sweeps the liquidity underneath the low, and it equally taps inside a strong demand level, right? Price taps inside a strong demand level. This is where we now see the reaction to the upside. Let me zoom in so you can see clearly. This is where we have the reaction to the upside, and it sweeps the liquidity above this particular high. Remember, this is actually our first target, or possibly our second target, because the first target has to be the 50% of the range. Price sweeps the liquidity, and over here we have another CRT where price sweeps the liquidity underneath this particular range. Not just sweeping the liquidity underneath that range, it equally taps inside a fair value gap. I hope you can see that. It came back to rebalance the fair value gap right here. Now, what do you see? We have a massive reaction to the upside. I hope you can clearly see that. This is a very good concept if you decide to trade it. Now, we have another one right here. Over here, we have another CLT pattern where price sweeps liquidity underneath this low, closing back inside the range. And it has high probability. Why? It rebalances a fair value gap right here, and from there we have the reaction to the upside. And the most important thing is that price sweeps the liquidity above this particular high. It has high probability of playing out. So currently, if you look at Bitcoin, you can see we're having great reaction to the upside. Bitcoin is reacting massively to the upside, and as of today, Bitcoin got to 98K. What initiated this move? From CRT point of view, if you come to this particular low, you can see we have a very good CRT pattern if you want to consider that. I don't know if this one is actually valid, but you can tell me in the comment section. So from this particular area, what we can clearly see is firstly, price sweeps the liquidity underneath this low, right? Price sweeps the liquidity underneath this low, closing back inside this range. I hope you can see. Although we have the first pattern where it didn't play out, and remember, nothing works 100% in the market. So price sweeps the liquidity underneath this low, which is a CRT pattern. And secondly, it's reacting from a zone right here. And just like I said, if you understand the fractal nature of the markets, if you drop to the 4 hours time frame, you're going to see a very good demand zone inside this range. So price forms that, then we have the reaction to the upside. Now from there, price moved up to 73K, right? Price moved up to 73K. And after that, we have the reaction to the downside, moving back inside a demand zone. In this case, you see, this is a demand zone. Price moved back inside the demand zone. We have a CLT pattern right here. Although this particular one, I'm not actually going to count it as a valid one, because after price sweeps the liquidity underneath this low, it's moved immediately up to take the liquidity above the particular high. It swept the liquidity slightly. So I'm not actually going to consider this particular one if I want to trade. But the main reason I'm making this lesson is to help you understand that after price mitigates this demand zone, sweeping this liquidity underneath the low, now we have the massive reaction to the upside. So I think we should see more examples. So this is CAD CHF, and this is on the daily time frame as well. So we are doing the exact same thing. Now, if you look at this particular high, you can see we have a CLT pattern, and this particular one tabs into a supply level. And from there, you see, price has moved massively to the downside. But that's not the main reason I'm doing this particular lesson. So what I want to cover in this particular one is identifying a liquidity sweep area, identifying an old high or an old low where price takes liquidity. So at this particular point, if you look from your left, you see we have an old high right here. And you can agree with me that liquidity rests above highs and lows. So we have a lot of liquidity resting above this particular high. Now, what you can clearly see from here is that we have a CRT pattern. And if you look at that, what did price do? Price sweeps the liquidity above this particular high. It's a CRT pattern. And what other confluence do you have? Price sweeps the liquidity above this old high. So this simply means that we're going to have a reversal. Now from there, price reversed to the downside, targeting this low right here. I hope you can see a very simple pattern. After price sweeps this liquidity, closing with this particular candle, we have another CRT pattern in this case, where price sweeps the liquidity underneath this low, closing back inside this range. This is a CRT pattern that has high probability, and we equally have a good level right here. This is a demand level. If you drop to the lower time frame, you're going to see it clearly. Now, after that, we're having the reaction to the upside. I hope you can see that. We have this reaction to the upside, and price is able to sweep the liquidity above this particular high. So I hope this makes sense to you all. And I don't know if we need to see one more example. Maybe let's see one more example on AUD card. So this is the last example on AUD card. So I've been keeping my eye on this particular one. In this particular case, you see we have a key demand level right here. We have a key demand level. And if I try to move the zone a little, you're going to see that we have a very nice CRT pattern where price sweeps liquidity underneath this range and moves back inside the candle range. Now price mitigates our demand level, which has now improved the probability of this setup. Now after that, you see price moves to the upside, taking the liquidity above this particular high. A very, very good pattern. And based on this pattern, I'm actually expecting a continuation to the upside because price is reacting from a very good demand level. Okay, so I hope this makes sense to you, and I hope you're going to practice this after now. This concept is the CLT pattern, combining it with key areas in the market, key areas such as supply and demand. So it makes sense to me, and I hope you got value from this particular lesson. So if you got value as usual, I hope you to go back to your price chart and practice this particular concept. So if you have any question, you can go ahead and ask. And if you're yet to subscribe to the channel, kindly subscribe to the channel. And if you want to join our free Telegram community, the link is in the description. You can look to join our free Telegram community. So I hope you got value from this particular lesson. Thanks for watching this particular one, and see you in the next lesson.